it has been my opinion for a while that this is probably, well, not now probably, it's factually the largest economic event of probably all modern history. I mean, it's unprecedented in the US or in Western developed countries.
Yeah.
We've never had a global supply shock and demand shock and an oil shock all at the same time, whilst we were having tariffs and trade wars. I mean, Christ, you couldn't make this stuff up. And no wonder it moved fast, because that's everything all rolled into one.
Yeah, I mean, I think the oil story, if we hadn't had the virus, the oil story alone would have taken us down. Maybe not as severe or as sharp or as much, but I think for sure, oil is down 70% on the year. It almost felt like a September 11th attack. We were going into the weekend with the virus just about to kick off. Things were bad. And then all of a sudden we get hit with this thing on top of it. So, I question the Russian, Saudi. Again, I don't want to be, I don't really know. We don't want to hypothesize too much in the realm of, extreme theories. But it did seem very strange that they hit us right as we were on our back. And maybe there are ramifications for them later on after we stabilize. I don't know. But I think it's the combination of the two that really hit it bad. And the last 3-4 weeks has been the worst sell-off basically that we've ever had. There's 87, of course, in one day and 29. But again, three episodes in the last 100 years. So we're living through real bad right now.
So the question is, Dan, that everybody needs to get through their heads, because the market's kind of saying it's like a version of 1987.
Yeah.
My view is actually 1929, because the potential for some outsized outcomes later. How are you thinking this through? I mean, obviously none of us have a certainty in this, but we're just trying to get to grips with what could be happening.
Yeah, I also think, and I've read this a few different places, but we both remember 07, 08 took a long time. I mean, it was months and months, and it was hemming and hawing, and we need TARP, and then we don't, and all sorts of different things that they had to work through before getting a bigger package passed. This was instantaneous. And so in 87, you had Greenspan easing. That was at that time, I think, I think that was a very bold move, and he reacted quickly. Bernanke was very slow in 08. Also, the 01, 03 post-NASDAQ drop, that was a slow thing. And so the response has been unprecedented. 6 trillion, yeah, but probably globally it's more like 12 to 15 trillion in liquidity. And the key word is unlimited. And, as a gold investor and gold guy for the last, 25 years, I've been waiting for the unlimited, sign from the Fed. We got it from the BOJ years ago. Then we got negative rates in Europe. We got Draghi with the, he'll do anything in 11. Was it 11 or 12? Was it 12? Or was it 12? We'll do anything. And finally, last man to drop, right? We got the Fed. And so I would say the markets and also policymakers are really on top of this. And let's not have a philosophical debate at the moment about whether it's right for them to intervene. A lot of people think, oh, well, we shouldn't let the markets clear. Well, the markets froze, right? There was a week ago. There were no credit markets. There was no trading, no bids,
and there's still problems.
Right.
Treasury markets still problems.
Right. But I would say that response that quickly in the face of the data that we know is bad, I think really takes the tail away from this in the immediate future. So yes, can we retest the low? Sure, but they're going to be vigilant. Unlimited means unlimited, and so what for me, hopefully, what I'd like to see happen is for them to peg the 30-year mortgage rate at some level lower at 2% and 1%. I think 30-year mortgages are still 3.5%. They said they're going to be in there buying. Now, again, you may say, okay, well, that's only a short-term thing. But I think that would be a tremendous boost for most of the population here who would either refi or even consider buying a home once things stabilized. I think they'll be in buying the credit markets, buying mortgages for months and months into the future. So we're there. They're on top of it. They've set up.
So I think about this, Dan, and I agree. It's been amazingly quick, but we had a roadmap that we've used before, so we kind of had some idea what to do. But when I look at it, if I look at, okay, let's assume GDP has dropped maybe 20% or 25% in this quarter. If GDP's dropped this much in this quarter, that equates to, let's say, $1.5 trillion of GDP just got wiped out in one go. Then you take the asset market liquidations and stuff. So we're probably at 4 trillion or so there. So the Fed have basically, there's no net stimulus. They're basically just papered over the crack. For net stimulus to take place, you're going to need a lot more than this. And I think it will come in due course. What they've done is papered over the crack as fast as possible, which I think was the right thing.
Yeah, well, you could even go further. If you want to take that line of reasoning, you could say that, real rates have risen. They were minus 80 basis points. They went to plus 50, and they've come back down negative again. That's on the 5-year real rate. And that's happened because inflation expectations have dropped more quickly than interest rates. And that comes from the oil shock, also the wealth collapse, et cetera. So you could argue that the easing that they've done, the Fed funds cut, hasn't even yet really flowed through. And secondarily, the strength in the dollar has definitely acted as a tightening as well.